Market's off to a pretty good start for the month of June. The major indices up more than 15%, of course, so far this year. Our next guest is known as Dr. Doom, but is he still bearish? I want to bring in Marc Faber, the publisher of the Gloom, Boom, and Doom Report, who joins us this morning from Boston. Marc, good to have you. Welcome.
It's my pleasure. Thank you.
Intriguing piece in Barron's a few days ago in which you said that you've heeded the advice of the likes of Ray Dalio, trying to keep some of your assets in equities. You say, I haven't shorted anything yet, although I am tempted to short the S&P or the Russell 2000. So how tempted are you today?
Well, basically, we had, since May 22nd, quite a sharp drop in markets around the world. Say in Turkey, we're down 15% from the high. Japan also dropped from the recent high by 15%. In the US, many stocks have given up gains, and they are no higher than in February. I think the market is rolling over. Now, very near term, we're a bit oversold, and we may rally back to around 1660 on the S&P, 1670, and even on the back of the strengths of Intel, Microsoft, and IBM, we could make a new high. But the new high would not be confirmed by the majority of shares. So I think the market is actually quite vulnerable.
Marc, what leads us to that new high from some of those large cap tech names that you mentioned?
Well, I think a lot of large cap stocks like McDonald's and Coca-Cola, Walmart, and so forth, Procter & Gamble, they have most likely peaked out. But as I said, there are still some stocks that show strengths that could continue to appreciate because all the money flows into fewer and fewer stocks, the momentum shares, and that could bring a new high, possibly around 1700 on the S&P. I wouldn't bet on it. As I said before, if someone put a gun on my head and say you have to be long or short, I take the short side.
Marc, still this follows a day where we heard, for example, Nouriel Roubini talking about the prospect for stocks to run for a couple of more years, supported by Fed policy. So do you disagree with that view?
Look, I know Nouriel very well. He's an outstanding economist. I wouldn't use him now for giving me advice when and to buy and when to sell shares, nor when to buy gold and when to sell gold.
I guess my point being, if you agree with the fundamentals behind that argument, granted, as you say, he's talking about the macro stuff here, but we've heard this argument from quite a few people. A lot that say, look, you can't fight the Fed here. I just wonder, what is your case? Is this about starting to fight the Fed, about believing that actually they can't continue to keep a bid in the market here?
Well, I know people like Nouriel, who, when in 2009 the S&P was at 666, said that the S&P would drop to 400. They were fighting at that time the Fed. Since then, the market is up something like 140%. You didn't have to fight the Fed until now, but in my view, the global economy isn't growing much, as is evident from the sales report of McDonald's, Caterpillar Tractor, and so forth and so on. So the market is a discounting mechanism. It has already discounted quantitative easing unlimited, as I said 3 years ago. It's never going to end. They will continue and continue and continue, but the impact of continuous monetary easing is diminishing.
Marc, when we talk about global growth, we also tend to think about China. You've spent most of your life living in Hong Kong, certainly a lot of time.
Yes.
Give me your insights in terms of what your expectations are from the new leadership in China and for what it means for the ability of that enormous country to continue to grow anywhere near the rates it has in the last few years.
Well, I think this is a very interesting question, and I'm just celebrating next month 40 years of Asia. I came to Asia in 1973. And what I think is happening in China is there's no question about the fact that in the last 20 years, China has made huge progress, huge economic development. But I equally feel that post-crisis in 2008, there was massive fiscal and monetary stimulus that has led to a huge credit bubble. And I think that credit bubble is rather dangerous. And I do not believe that the Chinese economy is at the present time growing by 7.8%, but rather like 4% or even less. And I think the credit bubble will come undue sooner or later. But having said that, when your viewers consider China, they have to see China is a country twice the size of Europe and the US combined in terms of population. So you can have some sectors and some regions, like the US has California. Occasionally California has a recession, but New England is booming. The same can happen in China. Some sectors are contracting, some provinces can still grow.
Hey, Mark, you know what your critics often say? They call you a fearmonger. They say you've cost people a lot of money as the market has rebounded. The notion that you've been in stocks, even as you've warned people about potential downturns or recessions, strikes some as disingenuous. How do you respond to that?
I respond to this as I have my asset allocation, that I turned bullish in 2009 about equities, that I've been positive about gold since 1999. And I think if you look at the tables of stock recommendations that are publicly available, I've done very well. So with my asset allocation, that is 25% in stocks and 25% in corporate bonds, mostly in emerging markets, I've done well. But I'm very concerned about the future from here. The corporate bond market in emerging markets is fully priced. And as you know, the high yield bond market in the last 2 weeks has gone down by something like 6-7% already. And the equity markets of the Philippines, Indonesia, Thailand, they are in the sky. They are already expensive. Good companies, they sell at 20 to 25 times earnings. Yeah. I don't think there's great value there.
So that 25%, to what level do you see that number going for your account?
Well, I think it will not go higher. I rather think that I will reduce the equity exposure in some countries, but I'm buying Vietnamese shares, and I'm thinking, I haven't done it yet, to buy at some point some Chinese shares. But the good companies in China are also expensive. They're not cheap. Right. And the last fall, last November, I said, buy Japan. Since then, Japan was up more than 70%, and in dollar terms, 35%. I want to buy more Japan on a setback.
Mark, real quick, you mentioned here we're at a point where Fed policy is losing its impact. It's actually the exact same argument that we've heard Bill Gross making of late as well. So just to play devil's advocate, if we get a jobs report that comes in weak, if there are more signs that the U.S. economy is rolling over, is the Fed out of ammo here?
They will continue to print, in my opinion, and I don't think they will have an exit strategy ever. There is no exit. They are so deep into essentially monetizing the U.S. debt. The U.S. Treasury and the U.S. Fed is one and the same. The U.S. Fed buys essentially what the Treasury is issuing in terms of treasuries. And so this game will continue for a long time. But the impact on the asset markets, that is the question.
Mark, it's always good to have you. I love that tie. Please come back very soon.
Thank you very much.